Hi, welcome to the Introduction of Risk Management. My name is Joe Racy. I'm an instructor with the New York Institute of Finance, and I'll be the instructor for this course. The Introduction to Risk Management is designed to give you a broad overview of the risk management discipline. We will first start by taking a look at some definitions. What is risk? What are the risk management disciplines? And especially what is enterprise risk? From this lesson, we'll then move into market risk, then credit risk, operational risk, and enterprise risk. After enterprise risk, we'll then take a look at the financial system as well as a comparison of major regulators. But first, let's start with the organization of risk. Let's start with what is risk? Risk is the potential for deviation from an expected result. We have risk in our daily lives as well as being risk managers. But when you look at risk, what you're trying to measure is the probability that something is going to happen differently than what you expected. Essentially, that's what we're trying to measure as risk managers. If we could measure that potential for the deviation, then that is actually what you begin managing because you're managing it toward your expectations. Risk management is also divided into three disciplines. There's market risk, credit risk, and operational risk. Market risk is the risk you have toward asset prices, interest rates, some type of asset. Credit risk, on the other hand, is counterparty credit risk. Essentially, somebody owes you money, but that could also actually come out of an operational process. Operational risk is people, process, systems, and external events. If you take out market and credit risk, largely the residual risk that's left over is generally considered operational risk. Enterprise risk is a relatively recent function within risk management. Unlike market, credit, and operational risk, however, enterprise risk is a process, and it's a process that tries to align risk management with corporate strategy. But in order to do that, enterprise risk has to have a facilitation process that works with market, credit, and operational risk in order to provide a holistic and portfolio view of risk. Risk does not happen in isolated events. Generally, when you look at large events, there's some type of interconnectedness between the risk disciplines. As an example, let's take a walk through COVID-19. COVID-19 started in a single province. It was a health and safety event. As a health and safety event, COVID-19 started as an operational risk. From this initial operational risk related to health and safety, what was called into question is concern around Chinese economic growth. Because China is a linchpin, especially in the global manufacturing chain, concern around Chinese growth then led to concern around global growth. So from this operational risk then, what we saw is an asset price correction through market risk. Then, as a response to the asset price correction, you saw central banks as well as governments providing economic and fiscal stimulus in order to avoid contagion going from the asset price correction to counterparty risk. What we did not see with the economic downturn coming out of COVID-19, we did not see the level of counterparty risk concern that we had in the 2008 downturn. That was largely because of the fiscal and monetary stimulus from the central banks as well as governments. However, coming out of COVID-19, we did see that the major global institutions did supplement their loan loss reserves because what they were getting ready for are potential write-offs further down the road as COVID-19 begins to run its course. So what we basically saw with COVID-19 and the current pandemic is the linking of each of the risk disciplines and how it affects one going into the other. As risk managers, we need to take into account both quantitative analysis as well as qualitative analysis. And COVID-19 is a perfect example of that. But let's take a look now at how we measure risk. When you look at data, data could be stratified in any number of ways. And as risk managers, we're very dependent on data. One way to look at it is to classify it by what's called known knowns, known unknowns, and unknown unknowns. I know that sounds quirky, but let's take it one step at a time. Known knowns is you know the probability of something and you know what the potential impact is. When you look at known unknowns, you may know that something exists, but what you don't know is when it is actually going to manifest itself. Now, this category, in taking a look at trying to measure risk, goes into the realm of emerging risk and strategic risk. As an example, with climate change, there could be the potential for rising sea levels. We know that's a potential, but we don't know when it's going to happen. There are various models that project it, but nobody really knows that with uncertainty. So that goes into the concept of known unknowns. And the reason why the reason why risk managers put things into data classifications like that is each one of them has a different response and monitoring mechanisms. Emerging risk is getting a lot of attention, especially recently, because of the level of volatility that we've seen in the 21st century. To put in perspective the volatility of the 21st century, think about the associates entering the workforce today. They have lived through 9/11, the 2008 downturn, as well as the current pandemic. And in between those three large events, there were other significant events that actually happened. The third category of data classification are unknown unknowns. In risk management, we often refer to these as completely random events. Random events happen. As risk managers, we need to work with our management team in order to have escalation protocols in place that help firms actually manage in the event of a completely random event. When you look at risk management is a dynamic process. First, we need to identify the risk. We need to determine the probability and impact. We also need to determine from a decision-making perspective, what risks do we assume? What risks do we accept? And what risks do we want to avoid? Then risk managers need to have monitoring mechanisms because that's where the management comes into place. And you have these monitoring mechanisms to where you're constantly evaluating the known knowns, especially the known unknowns, but you also have to have in place the protocols and escalation protocols, especially to where you can actually manage completely random events. And that goes into event management as well as crisis management. One of the key analytical processes risk managers use is root cause analysis. When things happen, we have to learn from them and we then have to make adjustments to it. It's very imperative for risk managers to have a proper root cause analysis because with the root cause analysis, that could show certain flaws within our risk management systems, and then we need to plug that. Risk management also should help a firm anticipate risk events. And this is becoming more important over time. And to put in perspective what's at stake, look at the original listing of the Fortune 500 companies that goes back to the 1950s. Nearly 2/3 of the original Fortune 500 companies are no longer in business. And the speed with which changes are occurring is actually happening at a faster and faster rate. Many of these companies were highly successful, but they didn't anticipate changes to the marketplace. Risk management is a dynamic process, but it's also forward-looking. And it's not just about avoiding risk, it's about anticipating risk. And in some cases, we want to avoid it. In some cases, we may elect to pursue risk. What you want to do is to have a decision based on the analysis to where you have a good risk-adjusted return. At this point, what I'd like to do now is we're going to introduce market risk. Let's now take a look at market risk. Think of risk management as part art and part science. When you look at market risk Market risk for risk management is more of the science. When you go past market risk into credit risk, it becomes a little more on the art side. As you go then from credit risk to operational risk could be considered more art than science. Regardless of whether it's quantitative or qualitative, it takes a combination of both quantitative analysis and qualitative analysis for good risk management. And while market risk is the most quantitative of the risk disciplines, there is a qualitative aspect even to market risk. But at its core, what market risk management seeks to do is to utilize market data as well as statistical measures in order to identify, assess, and measure risk to create economic value. The goal of risk management is not necessarily to minimize risk. The goal of risk management is to have a good risk-adjusted return for the risk you assume. And risk should always be on a going forward basis. When looking at measuring market risk, what you want to do is you want to take a look at the level of risk you're assuming, but you also want to make sure that you're not assuming an undue level of risk. Statistical measures that are often used in market risk management include things like the mean, which is the average, standard deviation. The standard deviation measures deviations from the mean. But you also have to take a look at value at risk, which the value at risk is the confidence level under the normal distribution up to the confidence level of which you're trying to measure the value at risk. When you look at the normal distribution is known as that bell-shaped curve. In the middle of the bell-shaped curve, the mean is the middle of the bell-shaped curve. At that point, the mean is actually zero. And then what the normal distribution then does is the normal distribution measures the deviations from the mean. Generally, 68% of the observations are within one standard deviation of the mean. 95% are within two standard deviations, and about 99% are within three standard deviations. The normal distribution works especially with returns and yields. The more you add to the sample, the closer you get to that normal distribution. When you look at asset prices, however, asset prices have a log normal distribution, which is actually skewed to the right. The reason why it's log normal is that in theory, asset prices don't go negative, the same as you could have a negative return. That theory faced the reality in 2020, however. And what the markets actually saw in 2020 was the prices of oil in the futures contract actually went negative. And the reason why it went negative is it was taking into account the cost of storing the oil versus the cost of the underlying commodity. And what we saw is a disconnect between the futures market and actually the cash market. But oil itself never went negative. It was the futures contract that went negative. So what stands to be seen going forward right now is there the potential for any commodity that pays for storage to actually have a negative futures contract? But we'll get more into the log normal distribution more. But what I wanted to introduce with this is the normal distribution, because the normal distribution is one of the bedrock distributions that we use within market risk, because of the variation of yields as well as rates and returns on underlying assets. When you look at measuring market risk, a number in isolation is very difficult to put in perspective whether or not it's good or bad. So when you're trying to measure market risk, what you always want to do is you want to measure it against a benchmark. The reason why you want to measure it against a benchmark is you need a comparison. That comparison helps you determine if you're taking on too much risk or if you're not taking on enough risk. The benchmark allows that comparison in order to try to determine when you're looking at a valuation and a portfolio, whether or not it's actually sufficient. So having a good benchmark is very critical to the measurement of market risk. Portfolio construction. There are a number of different assets that could go into a portfolio. Risk and return is essentially a trade-off, and the risk management process is a decision-making process. One of the things that risk managers also use, as well as portfolio managers, is what's called the Sharpe ratio. The Sharpe ratio focuses on the total risk measured in absolute terms. Another statistical term that's used by risk managers is the correlation coefficient. What the correlation coefficient measures is how related are assets to one another. And the correlation coefficient goes on a scale of +1 to -1. +1 being perfect positive correlation, -1 being perfect negative correlation. Just to recap, when you're looking at a portfolio construction, you want to take a look at the risk and return. You also want to know what the Sharpe ratio is, but you also have to have an asset allocation mechanism, as well as knowing how correlated the assets are to one another. One of the things about a portfolio, also from a risk management perspective, is before you begin building a portfolio, the first question you need to ask yourself is, what is the purpose of the portfolio? The answer to that question will drive a lot of the decisions that you make when constructing a portfolio. Let's move on now to the concept of the efficient portfolio. The efficient portfolio is one that has the best risk and return characteristics. So you look at return, you look at volatility. And what the efficient portfolio does is the efficient portfolio looks at the combination of assets, the combination of risky assets that are available in order to construct a portfolio. And what the efficient portfolio does is the efficient portfolio then has a combination of assets that go into a portfolio where the combination of assets through diversification actually decreases risk. That's called the efficient portfolio. And when you look at the efficient portfolio, it's not a straight line, it's actually a parabola. And what the efficient portfolio is, or what the efficient frontier is, it's the combination of all of the risky assets that could comprise a portfolio where you're looking at the return versus the volatility. And as you add more assets to the portfolio, what happens is you could actually increase the return while decreasing the volatility. But at some point in time, as the parabola shows, risk and return start actually going up. Generally, it takes at least 30 assets to have a diversified portfolio, but that also depends on the selection of assets. One of the ways of minimizing volatility is to add more assets to the portfolio. Each company has what's called systematic risk and unsystematic risk. Systematic risk cannot be diversified away, but unsystematic risk could be diversified away. Systematic risk is the risk that every company has, regardless of the way it's managed. Many of the drivers of systematic risk are things like monetary policy, fiscal policy, economic growth factors. It could also be the strength of the court systems. That's systematic risk. Every company in the marketplace has that risk. Unsystematic risk is very specific to the company itself. Unsystematic risk can be reduced by adding assets to the portfolio. And what happens then is unsystematic risk actually decreases and begins to approach systematic risk. That essentially is the point at which unsystematic risk approaches systematic, but you can never completely diversify away unsystematic risk. Where some of the drivers of systematic risk are things like monetary and fiscal policy, some of the drivers of unsystematic risk are things like quality of management. It could also be the industry a company operates in. It could be the culture of the company. These are things that are very specific to the company itself. When you do look at the selection of assets, you could also further diversify the asset base by taking a look at international diversification. One thing I would say, though, is that as you're adding assets to the portfolio, you do have to be aware of the correlation between the assets. If you do start adding things like mutual funds, you do have to be aware of the underlying assets that are in the mutual funds to see if they're correlated to actually your existing holdings. And even when you're looking at international diversification, if you buy an international company that's in the same industry as a current holding, you're not going to get the benefit of the diversification. If you add similar industries into the portfolio, instead of having diversification on 30 selections, what you may have to do is actually add your holdings to the portfolio to get the benefit of the diversification. But now let's take a look at the capital asset pricing model. The capital asset pricing model is a formula that calculates the expected return of a security based on its risk. Where the efficient frontier does not take into account the concept of the risk-free rate, the capital asset pricing model actually does take into account the risk-free rate, but it also takes into account beta being the company's systematic risk. The other thing about the capital asset pricing model is it takes into account what's called a market risk premium, which is the return investors want over the risk-free rate. If you look at it in terms of the formula, the capital asset pricing model equals the risk-free rate plus beta times the market risk premium. The market beta itself is 1, and every company has a beta driven off of its relationship to the market. If a company's beta is greater than 1, you would expect greater volatility. If it's less than 1, you would expect less volatility. The capital asset pricing model has many things that are limiting assumptions, such as transaction cost and taxes. Any model is built off of assumptions, and the capital asset pricing model is a model that's also built off of assumptions. You do have to take into account the limiting assumptions, but what the capital asset pricing model does do is it does take into account systematic risk, it does take into account the risk-free rate, and it does acknowledge that investors would require a premium over the risk-free rate in order to invest in risky assets. Now, if you look at the way the capital asset pricing model and the efficient frontier could be utilized, is the capital asset pricing model and the capital market line is essentially a linear line. And it starts actually at the risk-free rate, and it's a linear line. The efficient frontier does not take into account the risk-free rate. It only takes into account the combination of risky assets. Where the capital market line is a linear line, the efficient frontier is actually a parabola. Now, the tangent where the capital market line intersects with the efficient frontier, that is the efficient portfolio. And that's the combination of assets that's considered the market portfolio. So the capital asset pricing model and the efficient frontier could actually be used together in order to get a sense of the risk-free rate, the combination of risky assets, and what's the most efficient portfolio. When you look at capital market theory could be utilized within financial risk management. and especially the capital market line and the security market line. It's just important to remember that with the capital market line and the security market line, that does take into account the risk-free rate. The efficient frontier does not take into account. But using the combination of the efficient frontier and the capital market line, what you are able to do is get a better sense of what would be the most efficient portfolio. Now, before moving on to credit risk, there is an article as part of this lesson that is on which is on financial theory and financial risk management. It provides more detail on the capital asset pricing model, the capital market line, the security market line, the efficient frontier, and the efficient portfolio. So before going on to credit risk, can you please read that article that's part of the course contents? Let's take a look at credit risk now. Credit risk is the oldest of the risk disciplines, and it's just simply foundational to banking as well as financial services. Even though it's the oldest of the risk disciplines, even credit risk has changed over the years. But let's take a look now at how credit risk and market risk have actually converged. If you look at the way credit risk was done 30 years ago, it was a very labor-intensive process. You would have credit analysts working in banks, and they would look at various footnotes and financial statements. What began to change credit risk, though, is financial innovation. Credit risk derivatives were invented, and it completely transformed the way credit risk what was actually done. The reason being is it actually brought market forces into the credit risk arena, where credit risk was traditionally a very qualitative assessment. By introducing market-driven data through credit derivatives, essentially what happened is part of credit risk actually started to converge with market risk. They still continue to be two separate disciplines, but there is an element to credit risk now that's just fundamentally different to the way credit risk was done 20 or 30 years ago, and it's largely because of financial innovation. But when you look at credit risk is measured by the cost of replacing cash flows when a counterparty defaults. At the core of credit risk, it is that probability of default that's critical to understanding and measuring for credit risk. And that's where credit risk is still a different risk discipline. It has market forces, but it's still a separate and distinct risk discipline because at the core, you do have that risk of counterparty defaulting. Let's now take a look at pre-settlement risk and settlement risk. Pre-settlement risk is the traditional way of doing credit analysis. Pre-settlement risk is the risk that a counterparty has through the life of the transaction. So for example, if you have a 30-year mortgage loan, you have that relationship for 30 years, that's pre-settlement. Settlement risk is at the end of the transaction, and it's the final settlement that brings the transaction to a close. That's considered settlement risk. Pre-settlement risk is the traditional way of doing credit analysis, whereas with settlement risk also has an element of operational risk to it because you're using operational systems in order to bring a transaction to a close. So let's take a look at settlement risk. Trades could be classified in 5 different ways. They could be revocable, irrevocable, uncertain, settled, as well as failed. Now, there's a number of different ways of actually managing for settlement risk. But when you look at settlement risk, it arises when a trade is either irrevocable or uncertain. Because of the amount of capital that flows through the financial system, there's been a number of different ways that risk managers have used in order to mitigate settlement risk. One of the first things that was done is a real-time gross settlement system. That then would minimize the risk of settlement. The other thing that's used are what's called netting agreements. So if you have two institutions, they have multiple relationships. What they'll do is rely on netting in order to reduce the amount of capital that's actually flowing through the operational systems. And a combination of the real-time gross settlement as well as netting has allowed for better management of settlement risk. But let's now take a look now at pre-settlement risk. As I said before, pre-settlement risk is the traditional way of doing credit analysis. A couple of terms that's very critical to understanding pre-settlement risk is default, credit exposure, and the loss given default. Every credit analyst is always concerned about default. Default is the probability that a counterparty won't honor its obligations. As we said earlier, what is risk? Risk is the potential for a deviation from an expected result. You expect the counterparty to honor their obligation, but in the event of default, they did not honor their obligation. And what credit analysts try to do is try to measure the probability that a counterparty may not honor their obligation and thereby be in default. Credit exposure is the theoretical number that you have where your firm is exposed to the counterparty. Then the loss given default is assuming the counterparty defaults, what is the loss? So default, credit exposure, and loss given default are all three very important terms and foundational elements to understanding pre-settlement risk. But when you look at credit risk components, there's 4 different components that go into credit risk, and these also then go into credit risk modeling. One is the probability of default. When you look at credit scoring essentially tries to determine what is the probability of a counterparty defaulting. In the event a counterparty defaults, you want to know what the exposure at the default is. So the exposure is the total amount you potentially could lose in the event of default. The loss given default is usually a smaller component than the exposure at default, and this is the amount that the firm will lose in the event that it's default. So think about exposure as more of a theoretical number or a worst case scenario, where the loss given default is the amount the company actually will lose. Maturity is also very important with credit risk, because you could look at any of the credit rating, whether it's investment grade or sub-investment grade. The length of maturity invariably impacts and brings a higher probability of default across any grading category. So maturity is also very important as a credit risk component. So just to recap, when evaluating credit risk components, there's 4 core components: probability of default, exposure at default, loss given default, and maturity. But now let's take a look at the overview of credit risk. Expected loss and unexpected loss are also 2 terms that are commonly used with credit risk. The expected loss is the amount a firm expects to lose based on the credit characteristics of the portfolio. A perfect example of this is the loan loss reserve that banks have. Banks have loan portfolios. Each counterparty that is comprised within the loan portfolio is evaluated. There's a credit rating, and coming out of that credit rating is an expected loss based on the credit rating. then what banks will do is banks will take a provision expense, but then the offset to the expense is the loan loss reserve, which is actually what's called a contra asset and is netted against the loans. So the loan loss reserve represents the expected loss for that loan portfolio. However, an unexpected loss, it's not part of the credit analysis. It goes beyond the expected loss. Unexpected loss is what goes against capital. And later on, we'll also cover this as part of liquidity and capital. What is the purpose of capital? Capital is there to absorb unexpected loss. So if you have a loan loss reserve and a counterparty defaults, it goes against the loan loss reserve. But then if you have other losses, the unexpected loss actually goes against capital. To understand credit risk, you do have to understand how the provision expense, the loan loss reserve, expected loss, and unexpected loss actually function together. When you look at the expected loss is the probability of default times the loss given default times the exposure at default. The way to think about the unexpected loss, it's the loss that's over and above the expected loss. Now, another concept of credit risk that I want to introduce is economic capital. When you look at economic capital, it's the amount of capital assessed on a risk-adjusted basis that a firm needs to insure against the worst case scenario. So generally, when you look at economic capital, you will see that economic capital often has extreme but plausible events, and that goes into the capital calculation. There are various ways of measuring credit risk. One way is the notional amount. Now, what I'm going to walk through is a series of ways that credit risk has actually been measured over the years, but also how it's changed. So at one time, notional amount was the primary way of establishing limits, even for loan portfolios. From the notional amounts, then, the concept of risk-weighted amounts started to be introduced. Then, as time went on, now you have the internal portfolio credit models, because with the advent of technology and financial innovation, we have better ways now of modeling credit risk. So rather than relying on notional amounts, now you have internal portfolio credit models that better model the exposure in a loan portfolio. And it was really the technology innovation as well as the financial innovation that has allowed us to actually have better models as it pertains to credit risk. As I mentioned earlier, credit and market have converged in certain areas, but they still remain two very distinct disciplines. And when you look at it, one of the ways of looking at it is the source of risk. With the source of risk, market risk is very much determined by movements of the market. But credit risk has another element to where you have the probability of default, you have recovery. It's a little more complicated from a modeling perspective than just relying on market data. As we said earlier, market data is more science than art. When you start going into credit risk, it's a little more a combination of the science and the art. Also, when you look at the time horizons, a credit relationship can be a very long-term time horizon. When you have a credit relationship with the bank, especially for corporations, that relationship could span many years. With market risk, you actually don't have as long of a duration because it's considered more transactional. Another element of credit risk is that it actually has very high legal issues. The reason being is that if somebody defaults, if a counterparty defaults, it becomes a legal event. When you look at market risk, unless something happened which is either regulatory based, market risk has a low element of legal issue as a comparison to credit risk. So in many ways, market and credit have converged, but there are still certain components that's very distinct to both market risk as well as credit risk. But now let's go into operational risk. Operational risk has also made tremendous progress over the years, but it's also one of the newer risk disciplines. With operational risk is very specific to the firm at hand. It affects the people, the processes, the systems. Also with operational risk has this concept of external events. From a modeling perspective, especially because operational risk is prone to these random events, it's much more challenging from a modeling perspective. When you look at market risk is very heavily reliant on market data. That reliance on market data makes the quantification for modeling purposes very straightforward. When you go into credit risk, you have an element there to where you're starting to look at default probabilities of counterparties. It becomes a little less quantitative and becomes more qualitative. When you look at operational risk is very business specific. It becomes even more qualitative. So with each of the risk disciplines, you need a combination of quantitative and qualitative analysis. But with operational risk, getting the qualitative analysis correct is much more important. Now, given the nature of operational risk, the approach to measuring and managing it are a little different than credit and market. So let's take a look at operational risk. It's becoming more common to where operational risk is now commonly called non-financial risk. You do have to be careful, though, with calling it non-financial risk, because that does not mean that operational risk does not result in a financial risk. Case in point is the COVID-19 pandemic that we covered earlier. COVID-19 started as a health and safety event, which is operational risk, but that health and safety event caused a 35% drop in the S&P 500 portfolio, as well as global growth concerns. So you do have to be careful when you look at operational risk, because by calling it non-financial risk, somebody may assume that there's no interrelationship between operational, credit, and market. But when you do look at credit risk, it's embedded in organizations. It could also exist within instruments. And as I said earlier, it's very prone to operational risk. Because of the nature of operational risk, it's very important to have an operational risk framework. Now, somebody once told me that if you take out credit and market, operational risk is everything else. So the O could actually stand for other as opposed to operational risk. While that was said facetiously, I've always looked at operational risk as the intersection between business management and risk management. It's how the business runs itself. It's how the business actually interacts with external events. Where market and credit are based on discrete decisions, we elect to take market risk. We elect to take credit risk. Operational risk is actually embedded within the firm itself, and it's also influenced by external events. So because of the nature of operational risk, I think it's more important actually to have an operational risk framework, because you could better direct your resources if you spend the time to have an operational risk framework. Now, when you look at the portfolio of operational risk, it's vast. Where, again, in comparison to market and credit, where market and credit are very specific, operational risk tends to be the risk within the business itself. And because of that, the universe and portfolio of operational risk is much greater than credit and market risk. And as I said earlier, think about operational risk as the intersection between business management and risk management. Because of the large portfolio of operational risk, generally operational risk is classified into what we call specific risk types. And the specific risk types could be things like transaction processing, technology, external dependencies, human capital. Most firms have to disaggregate operational risk into these specific risk types because then if you have the specific risk types identified, you're better able to then build the measurement systems because you could direct the activity towards specific risks that you're trying to actually measure. And there's a saying, you can't manage what you can't measure. That's the thing about that links risk measurement and risk management is we seek to measure things to actually help us better enable us to actually manage them. And in the case of operational risk, identifying specific risk types is one of the foundational elements that allows us to maximize usage of our resources in order to improve our measurement because you could direct them at these specific risk types. When you look at the measurement of operational risk, while operational risk has a very strong qualitative element to it, operational risk also has certain fundamental aspects to it that helps us to quantify it. There are really four elements. One is you want to take a look at actual losses, right? So operational risk grew out of the insurance industry, and the insurance industry would use actual losses in order to help determine what premiums are going forward. When you look at what's called the loss distribution approach, operational risk managers will use actual losses in order to put those losses into an actuarial model, and they try to determine based on actual losses what the amount of capital covering operational risk is going forward. It's called the loss distribution approach. We will cover that, in more detail in the operational risk course. Losses themselves are backward looking. What risk managers will do is use the concept of key risk indicators to try to take historical losses and then to try to project those losses going forward. All risk management should always be forward looking. So using historical losses is important, but risk managers will also use the concept of key risk indicators in order to make that number more forward looking. It's called a qualitative adjustment. Another element to risk management is the assessment process. Now, the assessment process could be very qualitative as well, but the assessment process should grade the internal control environment and especially management's awareness of its internal control environment. This aspect of risk management starts to get what would be considered cultural. If management is aware of its risk environment, you'll probably have a better internal control process. Another element of operational risk management is you will hear the term governance structure is very common within operational risk, because if operational risk is where risk management and business management intersect, it's really the governance process that's that communication mechanism. And it's not just about forming committees. The governance process should also provide a usage of the operational risk information by business management as it's making decisions. Now, with operational risk management also works very closely with enterprise risk management. So what we'll do now is go into enterprise risk management.